Today, we are going to continue our series on momentum. We're gonna keep asking the questions. What is this thing? Why does it work? And what can investors do about it? Today, we are going to talk about the what and ask the question, is momentum investing just growth investing? You've probably heard that momentum and value are negatively correlated when going long short. Then this question kind of makes sense. If value and momentum are negatively correlated going long short, and growth and value are negatively correlated going long short, well, is momentum just growth investing? Semantics too don't help. The words growth and momentum sound kind of similar. In this video, we are going to investigate what is the relationship between value, momentum, and growth. I think it's best to get our definitions right. Once we get our definitions right, this is going to be a walk in the park. Let's start with value. What is value? Well, value investing means buying more earnings or assets for a relatively lower price as compared to other opportunities in the market. Take a value metric like PE, price to earnings. A deep value investor might want to have that P, that price, be really low, and the E, the earnings, be really high, so that they have to pay the least amount of money for those earnings. The expectations of a value investor might be twofold. First, he could be willing and able to take higher risk in order to garner higher return. After all, these securities are cheap for a reason. This would fall under the efficient market hypothesis worldview. Secondly, he could believe that this security is not as risky as the market is pricing, and he's betting on some mean reversion as the company potentially turns around. In this case, the investor might be trying to exploit the behavioral biases of market participants. Either way, value seems to be a great way to garner return, at least historically. Growth, on the other hand, is the exact opposite of value. Now, there's a couple ways to look at growth. The first way to look at it is that we are targeting growth in earnings. The second and more pessimistic way to look at it is that we are paying a higher price for these earnings. Now, whichever way you look at it, they're actually kind of the same thing. Here's a basic Gordon growth model. Growth investing simply means targeting a high G, or the growth of earnings or dividends. The mathematical effect of targeting a high G would be an increase in the price, and therefore a higher multiple or a more expensive stock. So to be precise in this video, we are going to talk about growth as the purchase of expensive stocks relative to its earnings or assets. Finally, momentum. Momentum is the purchasing of assets with high relative strength using price action history. Or in other words, targeting assets that have gone up more than other assets in a certain look-back period. You could see how just being precise about our language and defining things properly, we could see a distinction between growth and momentum. Growth means targeting expensive stocks according to some valuation multiple, while momentum means targeting things that have gone up based on price action history. But see, this is where it all falls apart, because there is this misconception in the market that things that go down in price are cheap, and things that go up in price are expensive. And this is best exemplified by the phrase, buy the dip. For the average investor, buying the dip simply means buying a stock when it has gone down in price because, well, it's cheaper. It has gone down in price. If you buy it, you could likely realize better returns once it inevitably goes up, right? This is held as a widely accepted view in the investment community. Buying the dip is the smart, courageous thing to do that really savvy investors do in order to get higher returns. But here's why buying a dip could mean that you are targeting a cheaper asset with higher expected returns, or it could also mean you're catching a falling knife. Here's an example. Imagine a stock. This stock is currently trading at a price of $100 per share, and its annual earnings are $10 per share. This is a PE of 10, so a relatively cheap stock. Some time passes and it's gone down to $5 of annual earnings per share. The market reacts and the stock goes down to $70. Now, a naive investor might think, oh my goodness, this thing just went down 30 bucks. It's so much cheaper. I'm going to load up. Well, is this investor right? Let's calculate our new PE. The new price is $70 per share for annual earnings of $5 per share. The new PE, 14. So in this example, this stock is now relatively more expensive and it has negative price action, both of which kind of line up against the evidence. In conclusion, a stock that drops could also become more expensive at the same time. So buying the dip in this case is not a good idea. Let's flip the tables and see what we come up with. Imagine a different stock. This stock is currently trading at a price of $100 per share, and its annual earnings are $10 per share. This is a PE of 10, so still a relatively cheap stock. Some time passes, and annualized earnings per share go up to 15. The market reacts and the stock goes up to 120. Now, a naive investor might think, I think it's time to sell. The stock just went up and it just got more expensive. Well, is this investor right? Let's calculate our new PE. The new price is $120 per share for annual earnings of $15 per share. The new PE, 8. So in this case, not only did the investor sell a cheaper asset, but he also sold an asset that just went up in price, both of which line up against the evidence. Hopefully by now you see how a momentum stock could be a value stock, or it could also be a growth stock. It just depends on the price action of the security. So if growth and momentum are not the same thing, and we know that generally speaking, buying growth stocks is not a good idea, then for value investors, there might be a case for targeting momentum. Here's Alpha Architect President Ryan Kirlin explaining how a value investor might go about utilizing momentum.
So momentum investing is really the ideal complement for somebody who's already doing value investing. With momentum investing, you're essentially going to be repeatedly buying whatever the hottest stocks in the market are. And with value investing, you're essentially doing the opposite. You're going to be buying the stocks that nobody else wants to own again and again and again, and hopefully they go up a little bit. With momentum and value investing, you're essentially giving yourself two diversified return streams. And that can be really important for two types of people. The one type is if you're near retirement or in retirement, it can be important to have diversified return streams because you feel like, hey, I can't have a bad run of returns for an extended period of time. Or if you're in a situation, which often happens, where it seems like everybody around you is making money and you're not, that can also be good to have multiple return streams to decrease the chances of that happening as well.
See, now that you know that momentum is not necessarily growth, it makes a whole lot more sense for an investor to potentially link value and momentum together, however that investor deems suitable. That's it for today. Thank you so much for watching. If you enjoy this content, make sure you like, subscribe, and share with a friend. Make sure to subscribe to the Alpha Architect blog at alphaarchitect.com/subscribe. If you want more content like this, make sure to follow me on Instagram and TikTok at Coffee Hour with Jose. I'll see you next time.